Good morning, ladies and gentlemen, and welcome to the 33rd meeting of the Agricultural Advisory Group. And as we begin to get started, what I'd like to do is begin by having introduction of the members of the AAC. So I will ask you to go around the table, identify who you are and who you are representing. And Bob, if I could start with you.
With the Renewable Fuels Association.
Jim Baer, North American Millers Association.
Darren Kopic, National Association of Wheat Growers.
Roger Cryan, National Milk Producers Federation.
Matt Bruns, National Grain and Feed.
Kent Pepler, National Farmers Union.
Kevin Natz, National Council of Farmer Cooperatives.
Sam Willett, National Corn Growers Association, and I'm joined this morning by Gary Niemeyer, a member of the Board of Directors for National Corn Growers.
Chad Burlett, Burlett Trading, but I was not a member of the AAC.
But you are a panelist today.
Good morning, Dave Lehman, CME Group.
Good morning, I'm Mark Worthy. I'm an employee of Flowers Foods representing American Bakers Association today.
John Blanchfield, American Bankers Association.
Neil Gillen, American Cotton Shippers Association.
I'm Beverly Paul with the American Soybean Association.
Robbie Boone, Farm Credit Council.
Mary Johannes, International Swaps and Derivatives Association.
Well, thank you very much. I wish to welcome you all to the Agricultural Advisory Committee to the Commodity Futures Trading Commission. As I said, this is the 33rd meeting of this advisory committee. The subject of today's meeting is convergence in the wheat futures contract and the proposal to implement variable storage rates on this contract. On April 22nd of 2008, the CFTC held an agricultural forum to address concerns about the volatility of the agricultural markets in the fall of 2007. At that forum, I asked who was responsible for fixing the problems that were identified. I stated, I don't think there's a silver bullet or a single solution for what ails the marketplace. And certainly the solutions that come up cannot be implemented overnight. But I firmly believe that the market participants are the best qualified to come up with solutions that will ensure that we have a viable, fair agricultural futures market that will provide a fair price discovery and for risk mitigation. This morning, you will see a chronology of how the market participants have worked to address wheat convergence concerns. As I predicted, solutions did not come overnight. However, there has been a continued commitment by the industry to work together to seek resolution of the convergence concerns in the Chicago wheat futures contract. I commend all of those dedicated folks that have been working on this effort. Today, we will meet to discuss a variable storage rate proposal that mostly everyone agrees is the next step in this multi-year effort to solve the convergence issue. As with everything, including the variable storage rate proposal, the devil is in the details, and the implementation of this proposal has been a point of contention between the exchange that owns the contract and some of the users who rely on it. I look forward to hearing from both sides on this debate today. I am hopeful that the discussion will help guide the AAC, the Ag Advisory Committee, in the Commission as it moves forward to resolve the convergence problem. As you all are aware, the CFTC has its latest proposal out for comment in the Federal Register. This is a material change to the contract, and as such, requires a vote of the Commission. The intent today is not to vote on that, but to hear from the subcommittee on its recommendations and hear the response to that by the Agricultural Advisory Committee. The transcript of this meeting will become part of the comment record of the proposal, and I encourage everyone to submit their views on this subject as soon as possible. I want to thank all of the AAC members and the presenters for their time, effort, and advice in these matters. I particularly would like to thank everyone who volunteered or was chosen to serve on the AAC Subcommittee on Convergence, who will present its report and recommendations today. The subcommittee's report should be viewed as a precursor to Commission action, but it will be used as an important source of information on the convergence issue. My commitment is to listen to you with an open mind, to your thoughts on everything we discussed today. And again, I want to thank all of you for your participation. I will turn it over to the chairman of the commission for his opening remarks.
Good morning. Thank you, Commissioner Dunn, for chairing today's meeting of the Agriculture Advisory Committee. I also want to welcome Commissioner Scott O'Malia to the CFTC. I note the importance of having a full commission, all 5 of us in place at this critical time in our nation's history and as we try to recover from the worst financial crisis in 80 years. I also want to thank the President for nominating and the Senate for confirming not only Commissioner O'Malia, but now Commissioner Summers and Commissioner Chilton, who we now have our full commission, and I think the next one of us up might even be Commissioner Dunn in 2011. So we've got a while until we are all together as the 5 of us, which is just terrific. I also want to join with Commissioner Dunn in welcoming this full committee and its members and wish to thank you for the advice and contributions that you've given in the past and certainly in this critical issue that we're facing today. The agricultural futures markets remain at the forefront of our regulatory agenda. The markets provide critical price discovery function for many sectors throughout our economy and not only affect the growers and farmers and merchants, but every American as they go to the food store and sit down for dinner at night. The Commission and the staff make policing these markets against fraud, manipulation, and other abuses a top priority. Now, as I sit here today, and I hope I'm able to join you for the full meeting, I know there were some bets on how long I was going to last here, but there are 3 things that I'd like to just listen to, and one, of course, is this wheat convergence issue that is the main topic. But also, I'd like to hear from people the thoughts on this critical thing we're doing right now with Congress to bring reform to the over-the-counter derivatives marketplace, how it affects the products and markets that you know most about in agriculture. But just as you've been watching this great debate go on, it would be terrific to hear your thoughts. Secondly, as you know, we're seriously considering imposing position limits in the energy markets, which, along with the exchanges we actually had in place through just 8 years ago, 2001. Be terrific, as we do have position limits in the agricultural market, to hear what works, what doesn't work, and just observations in the agricultural markets as we consider this in the energy markets. And then, of course, third, as we look to your advice in this wheat convergence issue, that's the main topic and the meat of the meeting, but it would be terrific to hear your thoughts on some of these other things as well. More particularly, convergence in the wheat market, the Commission has been very concerned about the lack of convergence in soft red winter wheat, the contract that we're chatting about. At the height of the poor convergence last year, you all know the figures better than I, and if I mistakenly remember them, but in the Toledo cash market, I think it was always hovering between $1.30, $1.15, and it even popped out to a $2 problem at some point. It has recently been brought in July and September in the 60 to 75 cent range, but it's still, and at least in my mindset, not satisfactory. At the core of these markets, it has to be far tighter than that and more predictable. In April, the chairman of the Agriculture Advisory Committee, Commissioner Dunn, brought together stakeholders affected by the lack of convergence, formed a subcommittee, which I applaud him for, and over the last several months, members of that committee have been working to identify causes of the poor convergence, provide recommendations to the full committee, and I look forward to hearing them today. But if I might, particularly, I'd like to understand from your point of view what continues to be the causes of the lack of convergence. For instance, is it the design of the contract, and if so, what issues? 2, is it just the nature of the markets in full carry and has been in full carry for such a time? Or, as many people observed, is it the role of index investors and the significant portion of the market that's held by index investing. To the extent it is contract design, of course, there's a recommendation in front of us from the Chicago Mercantile Exchange with regard to variable storage rate, and it would be helpful to understand whether that will address whatever contract design problems there are, or are there other contract design issues. It would be helpful to know. To the extent that you are supportive of this variable storage rate, of course, the timing of its implementation are so critical, and I know that's in front of you and all the work that Commissioner Dunn has done. So I thank you again, Chairman of this committee, Commissioner Dunn, for hosting this meeting.
Thank you, Mr. Chairman. We will now turn to Commissioner Summers.
Thank you. Good morning, and thank you all for being here to discuss the important issues in front of the Agriculture Advisory Committee. And I want to particularly thank Commissioner Dunn for his leadership on all of these issues, and those of you who have participated in the Subcommittee on Convergence. I appreciate your service to the Commission, and I look forward to your report and recommendation today. I also appreciate the Chicago Board of Trade's proactive efforts to try to find a solution to this problem, and our Commission staff who have worked very hard to help us better understand this complex issue. Over many months, we have devoted significant time and effort to examining poor convergence between cash and futures prices in certain agricultural futures markets, particularly the CBOT soft red winter wheat contract. The CBOT's recent rule changes that provided for seasonal storage rate, added delivery locations, and other changes have narrowed the basis, but the contract continues to exhibit a lack of convergence problem, particularly when the futures market is near or exceeds full carry. This issue is core to our mission at the CFTC, and I want to make sure that it is accurately discovering prices and is providing an opportunity for producers and commercial entities to hedge price risk. Many market participants have expressed concern about the continued usefulness of this contract, which is troublesome. I think we must attempt to restore the confidence that our markets operate efficiently and effectively, and to strengthen market integrity. Public confidence in the markets is crucial. I'm hopeful that through the dialogue today, we can come to an agreement on appropriate next steps that will allow us to finally move towards resolution. I appreciate all of your input over the past several months, as well as the time and effort you all have devoted to finding these workable solutions, and I look forward to hearing the discussion today.
Thank you, Commissioner Summers. Commissioner Tilton.
Thanks, Mr. Chairman. Thank you, Mr. Chairman, and I would thank the Chairman of the Commission for his tireless work on all these issues, and congratulate Commissioner O'Malley in particular, but also Commissioner Summers. I don't know if people remember back in the 90s, there was this catchphrase, not. You know, you'd make some declarative statement, and then you'd say, not. Nice tie, not. I want to echo what Commissioner Dunn and the Chairman were saying. This meeting is not about taking an action on the wheat contract. We're not going to take a vote here today. It's only to get your input. And the reason we want it in particular is because of this convergence issues that's been adequately explained. But you know, I'm concerned that we had some market moving event when the last time the subcommittee met on the conference call. And so I just want to make sure that people understand what we are not doing here today. I do appreciate Dave, CME, coming forward with a proposal, and I want to make sure that folks understand the lay of the land. When they provide a proposal to us, we have 45 days in which to act. In order to disprove what they have proposed on their contract, we actually have to show that it's a violation of the Commodity Exchange Act, that it violates the law. If we can't show that, we don't have a legal basis for disproving it. And that 45 days, by the way, is up on November 13th, I believe, November 13th. We can proactively, as the chairman of the committee said, approve it. We could also, by default, just do nothing, and it would take effect. So the other option in our little state of play here is that CME, if they believed that perhaps given market circumstances they might be able to do this in a more expeditious fashion, because I think a lot of people agree with the general constructs of what they've outlined, although we'll find out more today. But there's some issues on the date, too. And so it's possible that they could withdraw what they have before us and say that maybe it would be in May or maybe it would be in June. But that's CME's call. So I look forward to hearing people's discussion, look forward to hearing Dave's presentation also. The other topic I wanted to mention is related. While this issue may be dealt with, and maybe the market will take care of it. I mean, maybe this will all be resolved before we would get to sort of the remedy just by market forces. But I notice in our Commitment of Traders report that we released, the 3-year totals, that there is a heavy proportion of index traders that are, these are what I've called massive passives. These massive passives are large, they're long, they're price insensitive, they're not really trading in the market much. Now, not in wheat, but in some of the other contracts that are fairly small and illiquid, like cotton, and there's some others. Having this large group of massive passives who don't trade, I get concerned that maybe that would exacerbate a circumstance like we're having today. I'm not saying it is, I'm saying it's something that me personally, that I'm thinking about. And so I think in the future we need to be aware of that dynamic and try to come to grips with what, if anything, we should do. And then the last thing is I didn't want this meeting to go by without saying that it was about 1.5 years when we sat here and we heard from this committee about the cotton contract, the end of February, the beginning of March 2008. And we've had an investigation going. We announced it in June. Earlier this month, we received a letter from Senator Chambliss and 11 others, Senator Lincoln and 9 other senators, and they've urged us to ensure that we provide as much information as possible. And I can tell people that our enforcement folks have worked very hard on that contract, on that report, that investigation, and that I'm really hopeful that we'll get that out soon, and that we will give as much information, more in general than we do on these sorts of enforcement actions in the future. So I look forward to hearing from what you say, what you're going to say, and asking questions. I'd tell you I have 5 other points, but then I'd have to say not. So thank you, Mr. Chairman.
Thank you, Commissioner Chilton. It gives me a great deal of pleasure to say this. Commissioner Amalia.
Thank you.
Oh, no.
There we are. Good morning, Mr. Chairman. Thank you for the warm welcome. I greatly appreciate being here and having the nomination through. Congratulations to Commissioner Chilton and Summers as well for their swearing in. Commissioner Dunn, I appreciate you chairing this hearing to take testimony on the corrective measures identified to remedy fundamental problems with the wheat contract. It is so refreshing in my second week to take a nice, easy issue that is so cut and dry. But I am fully aware of the importance this product has on world food prices and the commercial implications to farmers, storage operators, and shippers, as well as those with significant investment in futures contracts. Although I'm in my second week, I am impressed with the body of work that the committee has produced on the fundamental flaws of this contract, and I compliment Commissioner Dunn, as well as the Commission staff and the subcommittee participants who have worked very hard to develop a range of options for us to consider. I'm very interested to hear the testimony of our expert witnesses, and I greatly appreciate everyone's participation here today. Thank you.
Thank you very much, Commissioner Amalia. Let me give a little outline of what's going to take place for the remainder of the meeting. We have 2 members of the first panel on to give us the market fundamentals and a historic overview. And after they have made their presentation, then it's incumbent upon the Ag Advisory Committee to have any questions that you might have of them, of what went on, what transpired, what the history is, and what the market fundamentals are. So they will make a presentation, and the AAC will be able to question them on that. Then the second panel we will have a report of the recommendation from the AAC Subcommittee, and then we will have a presentation of CME Group's proposal to implement a variable storage rate on that. And then we are going to kind of take a break so that everybody can kind of digest what they had heard so far. And then we're going to come back and we have a couple of reactors, Matt Bruns and Chad Burlett are going to talk about their reactions to what they had heard on this. And then I will open it up for any other public comments that they have on the proposals that are there, and then go back to the Ag Advisory Committee. It is your show, your opportunity to get the questions in that you need in helping you decide what area we might want to recommend. I'm going to be working from a consensus of what we hear from the various members, so we're not going to have a vote per se. But what we are going to be doing as commissioners is going to listen to the tone and tenor of what the Ag Advisory Committee have to say in their statements and in their questions in this arena. So let's start off then with that first panel, and we have two members of the CFTC staff, Dave Cass, who is with the Division Market Oversight in Chicago. When I first became chairman of the Ag Advisory Committee back in August of 2006, we had our first meeting. And prior to that meeting, Dave called me and he said, Commissioner, I've just had a meeting with a group of the Illinois Farm Bureau wheat producers, and they have a real concern about convergence. And let me show you some things. And so as an ad hoc to that first meeting, we invited Dave to come in to talk about convergence, and he is our man with the history on this. The second panelist that we have on there is Krista Lockenmeyer, who is a member of the Division of Market Oversight. And she is going to give us a background of what's taken place, a historical overview, and she's got a chronology that she's put in there that I think you'll all find very, very interesting. So, Dave, if you will, please.
Good morning, and thank you. Krista and I are going to essentially present sort of a factual underlayment. Hopefully, no opinions will sneak in. If one or two does, it'll be, of course, my opinions, not necessarily those of the Commission. But I'm going to talk a little bit about just sort of the history of basis and convergence in the wheat contract. This first graphic, and as an economist, of course, you lose your license if you don't present a whole lot of graphics and tables and charts, so I'll be doing that. This just shows absolute prices of wheat going back to January '04, so the better part of 6 years. And the red represents the difference in the with the cash price at Toledo, the Toledo bid. So where you see lots of red, that shows weakness, that the cash price was below the futures price. And interesting to note, if my little, at prices more or less above, let's say $9 or so, which of course were historically high prices that we reached predominantly last spring, we had awfully good convergence. Very little where you see red with cash prices well below the futures prices. But also, when you had prices from, say, $7 to $9, which historically would be very, very high wheat prices, there were also periods of time that you had bad convergence, or weak basis, rather. This doesn't necessarily show convergence, because convergence is a very specialized basis at or around the time of futures expiration. This is basis over a longer period of time. Now this isolates on just the basis, goes back further in time actually. This goes all the way back to January of 1996 and shows the Toledo truck basis, the major delivery point on the wheat futures contract and the soft red contract. And again, you can see that this is not a, although the problem got exaggerated, it's not by any means a recent problem. We had all the way back in this area here, in the late 90s, we had what would have been considered a very, very weak basis historically. Then we had the yellow parameter here represents plus or minus 10 cents of the nearby futures price. So that would be considered more or less reasonable convergence period. So that's what the yellow represents. And you can see that the history of this. Now, of course, basis and weak basis, sometimes you get weak basis for lots of reasons, and basis is related to a lot of things, not just what's going on with the futures expiration, but what's going on in the fundamental market, things like barge rates and lots of other things. But this is just the history of it. And obviously, we had that meeting in August 2006 that Commissioner Dunn related to, and at that time we saw a very, very high basis in that leading up to that meeting, and it was presented at that meeting as a terrible problem with weak basis and poor convergence. But then, of course, that was, we saw improvement actually for a period of time, and we got down to where we got some reasonably good convergence in late 07 and into 08, but then we all know what happened subsequently to that. This is a kind of the current situation for wheat basis at selected locations, just to kind of set this up. The boxes, the range from top to bottom of each of these little rectangles represents the historical range in basis at these points. And this is all for the 4th week of October. And you can see then where we were historically. The red triangle represents the median of that. And then you've got a green box and a blue diamond. The blue diamond represents where we were a year ago in basis in 2008, 4th week of October. And then the green box represents where we are pretty much current, at least as of last week in terms of basis. And you can see, for example, at Toledo, which again is the one historically people look at in terms of basis and convergence for this contract, because it has been the major delivery point. Last year at this time, we were about $1.50 below futures. This year, we're in the area of about 90 cents. But of course, the median period of time is closer to the 15 to 20 cent range. So even though 90 cents or so represents a substantial improvement where we were a year ago, when you consider the median was in the area of 15 to 20 cents, we've still got a long way to go. Moreover, at this point in time in October, we're not talking so much about convergence at this point in time because of convergence applies as you approach the delivery month. And of course, first notice day on the next futures contract is November 30th. So we've got about 5 weeks prior to first notice day. So you really wouldn't expect tight convergence at this point in time. This is just a summary, and I'm not going to go through this whole thing, but it's sort of what are the classic market forces in periods of time when you have a negative basis. This is only for a period of time where futures price exceeds the cash price as you approach the delivery month. And then you have sort of the classic situation that would apply. Holders of long futures products obviously would want to not get delivery and pay an expensive futures price for something they could get more cheaply in the cash, or if they were getting it and had to then liquidate that cash, they would obviously suffer a loss because they would be liquidating it at the much lower cash price. So they would tend to sell futures. If you needed the product, you obviously would not want, and you were long futures, you would certainly want to get rid of your futures and buy it in the cash market. Traders with delivery capacity can obviously profit in this situation from selling futures for delivery, buying the cash perhaps, and then issuing delivery notices and profit from that difference. So all of these things help convergence, all these acts by players in the market during sort of a classic. What happens at markets at full carry is quite different, at least for the first group, the long futures that really don't need product. They no longer have the threat of delivery because they're looking more at full carry. They can earn a positive return on invested dollars by taking delivery now. and carrying it into the a deferred contract, whether the next deferred or some further out. So they don't need to sell their futures contracts. They may buy futures, they may not, but in any event, they're not helping Convergence at this point in time. The middle group there, the long futures that need product, they'll act pretty much the same. Again, they're going to sell their futures and buy it cheaper in the cash market to the extent they need the cash. The other group that's affected tremendously by full carry are those with delivery capacity, the delivery facilities. You might think they'd be more than willing to make delivery at wide basis, where we were seeing a $1.50 basis at times in delivery period. But they would be reluctant many times to make delivery because anything they deliver out on the street, if it's going to be carried month after month after month, it's going to tie up their facility. Most of the delivery facilities are not pure warehousemen, they're merchandisers. And they want and need their facility for throughput. So their ability to sell futures and buy cash or deliver cash they already own can be very limited. They would do it up to a certain point of comfort, but once they reach that comfort level, they're not going to do it anymore. And if these things are carried over month after month after month, they may have reached their comfort level. So increasing delivery capacity, which of course we saw this past summer, may not have much effect on delivery capacity in the short run in a full carry market for that very reason. They may deliver a small amount up to their comfort level, but once that amount is sticky in terms of staying in their facility, that's it. You're not going to see a lot more capacity coming out of that. So that's the problems and the sort of the disconnect that you'll find in a full carry market situation. There's a lot of other nuances to that, but that's just a quick overview. This now, up to this point, I've been talking about sort of basis over time. Now we're going to talk more about the convergence, which is the specialized basis at or around the delivery period. The blue bars here represent basis on first notice day of futures contracts going back through March '98, so quite a long period of time. And this is the scale on the right-hand side. So you can see the zero line, which would be futures, cash equals futures. And then you see it falling below that at points. I have a little trouble picking this thing up. There it is. And obviously, again, you see this dramatic, basis here, looking at the blue, where we got down on first notice day, even basis approaching $2. It was well over, looks like about $1.90 at its worst point in September of '08. And going back historically, you can see there were other periods, even as early back in the late '90s and into 2000, where we had what at the time looked like pretty poor basis relationships. It only looks not as bad now. I'm going to be showing this same graphic, this blue part, in a later slide, so it's important to note what this is and what it represents. But one thing it does represent, during this period back here, we were seeing month to month, future to future improvement in basis. But of course, if you thought, gee, the problem is over, then all of a sudden you had, bad basis. But then again, in late '06, we had, again, a month-to-month improvement in basis, and one might have thought, well, if we weren't out of the woods back in the 2000, we're out of the woods now, the problem is fixed. And of course, not, as the Commissioner said. And you'll see now recently, basis has improved again month-to-month from September '08 through this past September of '09. Is that finally on the right track and we're going to get there eventually? Well, history would say maybe not. The red lines, by the way, represent the numbers of deliveries just on first notice day. So these would be initial deliveries. And you can see clearly where you have weak basis, you do tend to get heavy deliveries, of course. But apparently not heavy enough because here recently, and you can see in the last half dozen or so futures contracts all the way here on the right, we had the heaviest deliveries we've ever seen, and yet we still had poor convergence. So heavy deliveries doesn't even necessarily get you there. That one outlier there, May of '09, the very largest long, there was coincident also with a Board of Trade rule change where they restricted the number of receipts that could be carried over. So that was an unusually heavy delivery period because by the end of that month, non-commercials could no longer carry as many as they had in the past. So that's one of the reasons that one's particularly heavy. Now let's look at spread. I mentioned in full carry and spread. Let's look at spread. This goes back to March. This, by the way, I'll give full credit to this slide and the next one, the University of Illinois, that has been doing a lot of work on this as well. This now represents the spread on the first delivery day between the nearby future, the expiring future, and the next deferred future. The red line just sort of arbitrarily represents 80% or more full carry. And you can see then, going back, more often than not, we are above the full carry situation.
Could I just interrupt just one quick question on this full carry chart? Is this full carry at, as the CME proposal is LIBOR plus 200 basis points, or is this some other measure of full carry, if you could, Mr. Cass?
I believe they used LIBOR, but and of course it's 80%, and I think the Board of Trade's proposals represent 85. Actually, given current interest rates so low, I'm not sure that the interest rates would. It might move this a little bit, but it's not going to make enough to throw you out of a full carry into a non-carry, depending on which interest rate.
Would it not make a big difference if you add 200 basis points or not? Because that does really address what full carry is.
Well, I think I'll let the Board of Trade.
No, I was just asking what the arithmetic of this chart is.
Yeah, the arithmetic on this is LIBOR.
Thank you.
And the higher the interest rate, of course, the more it would take you to get to full carry. So this just demonstrates that we have been at or above 80% of full carry pretty much throughout history. There are a few here and there where we weren't. And then finally, my final graphic shows that Toledo wheat basis, which I showed you before, the little bars falling below the zero line, so that's the same. And it overlays now, using the right-hand scale, at what percent we were of full carry during these periods of time. So the red represents the percent of full carry. And the line there's essentially a line drawn at the 80%. It's the zero line for basis, but it's the 80% line for the purposes of what is full carry. And again, you see a pretty good correspondence between when you had periods above 80% of full carry tend to be associated with the times where we had the worst convergence. And periods where we fell well below 80% of full carry, those downward peaks, or I guess valleys, on the red line, typically you had much better convergence when you weren't at full carry. It's not perfect. There's a period of time you see back in about the, between the SEP 03, May 04, where we were actually above 80% of full carry looking at the red line, but we had very good convergence. So it's like most economic relationships. It looks like it sort of generally applies, but it's not a perfect relationship, and that's, we seldom get those sorts of things. So there's a lot of confluence of events that go into these, but carry does seem, and particularly when you get above 80%, does seem to have a good relationship here with the lack of convergence. So with that, I will turn it over to Krista.
Commissioner Dunn, could I just ask a clarifying question
Sure.
of Dave? Dave, the basis data that you presented, is that from USDA?
The basis, I think it's a private source. Hollander.
Oh, from Hollander and Verhagen?
Yeah, I think so.
Okay. And those are bids, correct?
Right.
So they're not prices at which
the elevator bid at the location on that.
A public bid, but not a transaction price.
Right.
Thank you.
Good morning. Thank you very much. I'd like to just set this up with a brief history of the convergence issue in the wheat contract, specifically relating to two sets of contract changes and the lead up to those up until the present point. First of all, in this chart, it starts in 2007. In blue, you'll see the delivery months below, and then the bar represents where the basis was at that point. You can see the peak period is in December, and it's been gradually improving since then. I believe Commissioner Dunn discussed the Special Agricultural Forum that led off this issue in his first meeting in 2006. And then that was followed by another Agricultural Advisory Committee meeting, which you know. And in August of that year, the CBOT sort of unveiled their first set of changes to the industry, followed quickly by the submission of the changes and their approval in December. Those changes were basically to expand the delivery territory, to reduce the vomitoxin levels, and also to institute the seasonal storage rate. And then, as Dave mentioned, the second set of changes was to put a limit on the number of certificates that can be held for non-commercial purposes. And you'll also see that the University of Illinois has done some exceptional research on this topic, and that we've had other government institutions involved. The Permanent Subcommittee on Investigations issued a wheat convergence report, and our chairman testified at that hearing, and then also there were research reports by the USDA. At the time when the proposals were submitted, the CBOT advised us that the proposed new delivery territories would foster convergence by expanding deliverable supplies, meaning that an increase in capacity would lead to an increase in supplies, and that the higher storage charges would improve convergence by allowing spreads to widen and the nearby contract to fall relative to cash values. So the alternative to that would be that the deferred price would go up, and we haven't been able to really see that the nearby has dropped or that the deferred has increased. And also that a reduction in the maximum amount of vomitoxin would enhance convergence, as it would reflect milling quality grade. So you'll see for the first change, I believe the slides in your packet may be a little bit different than what I see. The information is essentially the same. You'll see from when the changes were instituted to essentially the present, there's been a huge increase in capacity, over 115% increase. The unused capacity there is not empty. Essentially, it's capacity that the regular facilities can use to issue shipping certificates. You also see that there is a considerable number of new players, some cooperatives, that are able to deliver. And then in the table in the bottom left, you'll see that despite the increase in capacity, the registered receipts level has actually gone down. So it hasn't been exactly as anticipated. You'll also see here from this map that the new delivery is essentially coincident with vomitoxin outbreak along the Ohio River here in the northeast of the map, and essentially along the Mississippi River. So that may have resulted in wheat that was not of deliverable grade when the new changes were instituted. And then this brings us back to the basis chart. We haven't seen the improvement. We have seen an improvement, but not the one to convergence that we were hoping for. And so at the time when we when the commission approved the changes, there was some concern among staff and in the industry that they would not achieve convergence. And so what we did was refer the matter to the subcommittee on convergence and suggested some topics for them to look at, which is modified compelled loadout, restrictions on cash and carry, which is essentially the contract change in January that limited the number of shipping certificates that could be held, further increases in storage rates, cash settlement, and also restrictions on hedge exemptions. And at the time, we also noted that the CBOT was very cooperative in discussing new changes, and that's where this dynamic storage rate came from. That's it.
Thank you very much, Krista. I would now like to open it up for questions, and usually we allow the commissioners to ask first, but since this is the AAC meeting, we're going to let the AAC members question first, and then the commissioners on any follow-ups that they might have. So if you have a question or a comment about the presentation of the first panel, please just raise your hand and we'll call on you. no questions or comments, pretty much history, and everyone says that's correct. Very well, then. Let's go into the second panel, if we will. We have Andrei Kirilenko, who is with the Office of the Chief Economist, who was the staff person for the subcommittee for the advisory committee. And he will go through an overview of what they looked at and what their proposal. And then we will have Mr. David Lehman from the CME group talk about what the actual proposal was from the CME group. And please keep in mind that in essence, everybody is agreeing on what the next step ought to be. It's the timing aspect of it. So, Andre, if you will, please.
Mr. Chairman, Committee Chairman Dunn, Commissioners, members of the committee, I would like to organize my remarks not around charts necessarily, but around the sort of the principles and the philosophy that we had and to go in and trying to address this issue. Once it became clear over time that this issue of convergence is beyond day-to-day surveillance and not necessarily entirely the matter of enforcement, we moved and tried to understand this issue, research this issue, and try to understand these issues better, collect a body of knowledge so that we could then work on with the industry and the exchange on solving it. So to lay out the basic principles that we had in mind, what are the key issues? This contract is the property of the exchange. That's a fact. However, a persistent lack of convergence inhibits this contract's ability to deliver on its key public attributes. And so there is a consensus that over time developed in the industry that the problem is embedded somewhere in the aspects of the design of this contract that has to do with where it's delivered, how the delivery is scheduled, what are the rates associated with say, delivery or not delivery. And we also know that there are some incentives that are sort of aligned on the two sides of the contract. Some participants benefit from a lack of convergence and others lose. So there is, in principle, an inefficiency that has to be addressed. However, those who know how to solve these technical contract design issues are often the beneficiaries of the design. So there was a feeling that the regulatory intervention, regulation, or at least study is justified. So we first look at how we've dealt with issues of this sort in the past. And there's a history of involvement of both the precursor of the CFTC and the CFTC itself with both the wheat contract and the grains contract. You see that this is not a new issue. This issue goes back to a long time ago, even to before the CFTC was formed. I'll give you a quote from 1926. The FTC at the time suggested to Congress that the Chicago Board of Trade be requested to permit the delivery of grain on futures contracts at other important markets. So there was a whole report underlying that. In March 1979, the CFTC stepped in and ordered the termination of trading in the expiring March wheat futures contract in Chicago. That's a pretty critical, significant action. And among some of the reasons for the termination was a perceived distortion of price relationship. In December 96, the Commission issued a notification to the Chicago Board of Trade that the delivery terms on the corn and soybean futures contracts did not satisfy the objectives of the Act. And this action resulted in the creation of the Illinois Waterway Delivery System for corn and soybeans, which many industry participants feel works very well for these two contracts. So the initial involvement in the most current episode of convergence and contract design was to study the issue, to bring together industry,
academics, regulators together, and we held a number of roundtables, conferences,